Hello, everyone. We're going to go through the CTA reports. Now, we used to get some really good reports, or let's put it this way, a more diverse universe of reports. TD, Ameritrade, I think they're no longer in existence. I don't know where their analyst has landed, and several others. The best are Goldman Sachs's and Bank of America's. UBS is a close tie for second with Bank of America. But we're not getting as many as we used to, but we are getting the better ones now. So we're going to go through Goldman's and Bank of America's today in short order and get it out to you. Let's see, today is Thursday, May 30th. Get it out to you tomorrow, June 1st. And well, this is my first walkthrough, so my commentary will be probably after I look at it. This is for my own trading. So I'm sharing my risk management with you. All right. So let's see how this looks. The Bank of America report, I'll probably spend a little more time on than usual because I want to start sharing, for those of you that trade options on the S&P 500, I want to start sharing what they're talking about on that because they explain it a little bit better, in my opinion. You've heard them talk about gamma clenching and gamma wall and call wall. That's a zero hedge, label for it. And we're going to talk about it in what it really is. And not those expressions are perfect, but they don't explain, I think, to people that are actually trading it. Okay, so here we go. We're going to go with the PDFs. So it's Goldman's and BOA's Gold CTA analysis. All right, we'll start with Goldman. All right, May 27th, 3 days old. So for reference point, right? It's always good to get a little reference point. Let's see where the markets were on the 27th. Let's put a fine point on it. So this is a CTA position in gold, copper, silver, and everything else. After a steep decline in gold, after a steep decline, and I think we probably caught some of the rally, depending on what time of day they got this out. After the decline and pause in copper, and after the rally in oil. All right, so there's your perspectives. All right, so CTA trend 1 month conditional projections. This is all commodities. As you can see, it's relatively well balanced, but there's more selling below to snowball than there is buying above to snowball. That's a sign of a market that's net long. I say that because of the fact that this flattens out and this doesn't. So this is people with a lot of profits if they're selling all the way down here. You follow? 1 year net length by sector. Precious metals at the edge of being long, but off the highs, right? Market is off the highs. CTA positioning is off the highs. But market, look, until as recently as 2 years ago, this meant there was more selling coming. Now, from here to here, this market should have crapped out, and it didn't. So, this market is becoming more dynamic. Base metals, way too long. I like to see where that's coming from, considering that I'm pretty sure some people puked copper. Energy, net short working its way back to unchanged. That's energy, though. It could be wildly disparate between oil and natural gas. Net sector length. Then we go to sector length. We look at precious metals in general. They took out from 29 billion to 24 billion. No, I don't want that. All right, so oh, that works. So 29 billion to 24 billion. So a disinvestment from CTAs there. That, you may have heard me say before, that implies an investment in energy, right? Well, let's see, energy 35 billion, energy minus 3 billion. Well, that's wrong. Very wrong. Wow. Really wrong. So where does that money go? Where does that money go? Base metals stable. Okay, so this is, all right, so when you're wrong, like energy should be up if metals are down, or at least unchanged. It's a big swing in energy. Geez, That implies they got short energy after being long. It's slightly short, but short energy, and there's a lot of cash on the sidelines. Oh, here we go. Here we go. Grains, they were very short and they covered. So metals, they loosened, they reduced their positions in base metals, uh, taking profits, right? They sold it. It was off the highs, but they did sell for a profit. Grains, they got smoked on. And energy, I don't know what they did, but they closed it out there. All right, enough with that. Conditional market flows, WTI. So WTI, you can see how these truncate here. Well balanced is what that means. Brent, I'm not going to go with that, but I'm not going to go with one against the other. But you can see that for yourself. Gold. Okay, according to their model, there are no more buyers left, very little buyers left, unless the model breaks into a new paradigm, unless more money is coming. Now, I tend to agree with this more than usual because you don't get fresh CTA money until the middle of the year. Okay, if you get fresh CTA money, and if you do, it's not necessarily a lot. But again, CTAs are not driving this market. Macro discretionary is. So we look at CTAs now not as, oh shit, if they sell, we're going to drop, as, oh shit, if they sell, I wonder if it's going to be caught by the macro discretionary. That's the way to look at CTAs now. Copper, on the other hand, is not macro discretionary. So if you say, oh shit, they're going to sell, well, guess what? Unless there's news, it's going to drop. Okay. So copper is like silver was, right? Gold is like oil. So gold has become oil. It's bigger than the CTAs. Copper is like silver. It's bigger than copper. And silver is kind of on its way to being like gold in terms of liquidity. All right, moving on. Simulated historical length, 1-year time series. See, there you go. Natural gas, they all got long above $2. Every damn one of them. Crude, they're mildly short, and they're short all the cracks. Wow. I don't understand the logic behind that. That means it's probably not seasonality. They're probably working some algorithm. We'll see. Softs. By the way, for the record, you hear people talk about the widow trade or the widow maker trade, or silver is technically the devil's metal, and people like to call natural gas the widow maker, but it's not. The real widow maker, going back to the professional trading, is the heating oil versus gasoline spread. That's the widow maker. People who trade one against the other there, that's the worst of the worst. And you don't hear about it anymore because it's too bizarre. All right. Metals, 1-year time series. Gold, near the highs, but profitable. Usually when we're this high, it's on the highs, right? Usually when we're this high, it's on the highs and the next leg is lower. But we could have a leg lower, but mind you that the whole bar for risk tolerance in gold has been raised because they're making money. Aluminum, there you go. They're maxed out in aluminum. This is crazy, okay? Because they normally don't attract that kind of attention, right? This is their normal amount of volume. This must be massive volumes to get it all the way up here. Copper, big range, still at the upper end. Normally they're short copper. So, this is like, see their average is below the line, right? Silver, let's go to silver. Silver, their average is flat, which makes sense, right? They're usually long gold. They're usually short copper, and silver is the one that arbitrates the middle between them. Nickel, they're ridiculously long. Zinc, they're ridiculously long. And what's that? Lead, right? Lead, they're long as well, but at least there's a range in lead. All right. So when people say to you, like, SocGen just put out that they don't think too many people are long futures. Well, there's not a lot of futures length in aluminum and in nickel and in zinc, but it's not a big market. And so if you look at it from a normal behavior, the base metals are really overloaded. That's all I'm going to say. And that's where I disagree with SocGen's analysis then. All right. Cross-section momentum threshold. Let's work with metals on that. Let's make a little room. Can you see all that? Momentum thresholds cross section. All right, generally speaking, again, what you're looking at here is what areas in terms of percentage move that Goldman Sachs believes the CTA business will start doing trades. And this means liquidate or add. And usually these almost always have liquidations in them. So we'll just stay with gold here, right? All right. The S, short term. The M, medium term. L, long term. It's a time concept, not a size concept. But you're safe looking at time and size as being positively correlated. So if they're short-term oriented, they probably don't have a lot of money as CTAs. Medium and long have more. And long, I would say, long is representative of your hedge funds in general. Your longer-term players are your bigger players in CTAs, and there's an overlap with your macro discretionary types. Okay, so half a percentage point lower, your small guys are going to sell. 6 percentage points lower, your medium guys are going to sell. And 10 percentage point lower, your large guys are going to sell. Now, if you look at this and you want to swear by it, that's fine. But what you'll find is that that over time, the places matter less than how far apart they are. So if they're far apart, you have less of a snowball effect, right? But if we get to the middle one, you should expect it worse. So if they're bunched up, expect more of a snowball effect, okay? That's about the timing of when they got in. This is a stop loss. This is a stop loss. This is a stop loss. So between S and M, you're looking for macro discretionary to buy. Now, if they're bunched up and really away from the zero line, well, then they've been making money. If they're bunched up and really close, they're not making money and it's chopping them up, right? So in gold, what you see is spread apart and down and relatively down the line. That means the big guys are making money, right? They're long from 10% lower. Let's look at it that way, right? Silver, even more profitable, right? Silver down 7.5% for the small, down 15% for the medium, and down 18.7% for the large. Now, there are two things to keep in mind when you're looking at that. The first thing is silver's more volatile, right? So those numbers should be lower. But silver's also had a torrid run, right? And they're making money. And I'll say, CTA players, when the market is dominated by CTA players, frequently lose money. But when the CTA players catch it right, when they catch the wave right, the macro discretionary will reward them. And that's what's happening right now. So while I'm not saying the CTAs are definitely going to make money, they tend to be in for moves that last long and take a long time to regress to the mean, CTAs will make money. And they made money being short. Let's make sure I'm recording this. Yeah. They made money being short copper forever, being short silver forever. So think about it. They have the staying power to be long silver forever, provided it stays above a certain price, right? Now, they're not scared of silver, like people like us are, healthy fear. These guys, they're stupid in a smart way, right? All right. So lead, relatively new trade. Here's one for you, nickel. All right. Notice that it's green below and red above. The short-term CTAs are long and they will sell, right? This is green because they're long and they're going to sell it down 5%. And the medium ones are going to sell it down 12%. But the longer-term ones are still short and they will buy. Okay. They'll also probably buy to get long. So in nickel, what you have is the short and medium term CTAs have flipped towards bullish and they'll sell weakness to get out, right? Meanwhile, the big picture guys, CTA guys, which are much more like the macro discretionary, they're still bearish and they're closer to stopping themselves out, but they haven't reversed their positions yet. So if the market goes up 3.5% in nickel, you should expect, I personally believe you should expect massive buying, because what will happen is the long-term shorts will cover. Some of the long-term shorts will reverse and get long. And the small, medium guys will add to their positions. All right. This is actually something to watch, nickel. When you see this, one on one side and two on the other, pay attention. Rarely happens in silver. But when it does happen, you know not to take your profits at this level. You know to get longer at that level. All right. Aluminum, copper. So that's, we spent enough time on that. So you can see how that works. Grains and livestock, energy. All right. What is this? This is simulated realized flows. I'm probably simplifying this a little too much, but this graph is like the conditional graph, the chart with the lines above and lines below, but it's in graphic form. So we'll just do gold and silver here. So gold over the last week. Make sure I got this right. Yeah. Over the last week in metals, in gold, 4 billion. Is that right? Yeah. 4 billion was sold over the last month, I should say. And over the last week, less than $500 million. Now, this chart tells me as a trader, because I've seen the previous ones, that they've sold a lot in the last month, right? But they haven't sold a lot in the last week. So whoever is selling is done selling, right? The weak hands have been shaken out. Now, is there another weak hand that could be shaken out? Yeah, sideways could be bearish for these guys. And we'll look at that in the next chart. But net, a good chunk are out and the market is held. Confirms what we saw in the other chart. Silver, same idea, but less dramatic, right? I mean, silver, you don't know what's going to happen next week. Silver's still in the teeth of it. Energy, grains. All right, so here we go. All right, so this is given a move. Given a move, what will people do, right? Very similar to the minus 5%, minus 10%. Well, but that's a level that they'll participate. This is going to put a dollar amount on it. So in I chopped off the side here. Hold on. I got to make it a little bit smaller to fit it all. All right, so it's a little small. I'll read it to you, right? Conditional flat up down. This is actually very this is another version of the whisker thing up top, right? And in a flat market, this is what you'll hear if you read Zero Hedge, and they say in an up tape, a flat tape, a down tape. So in a flat tape, over the next week, expect 600 million, 6/10 billion of gold selling. That's longs getting out because they're losing patience. Pure and simple. Silver in a flat tape, look for buying. Now, why is that? That's because the silver buying in CTAs is not done yet. That's their opinion. Okay. Up 2 standard deviations. Expect more gold profits to be taken. Expect some silver selling net. There's going to be some of this buying up there, but there's going to be silver selling net. Down 2.5 standard deviations. Now, I don't know why they go 2.5, although I'm sure there's a reason for it. It's kind of like a risk thing. Crashes are more likely in commodities than spikes. If I were looking at, say, NVIDIA, maybe I'd be looking at it the other way. But down 2.5 standard deviations is probably also because you're zero bound on commodities, allegedly. Anyway, so down 2.5 standard deviations, everybody's selling everything in gold, right? But in silver, very little. So what's 2.5 standard deviations? How many percent is that? That's what you have to look up. That's what I'll have to look up later on. All right. So you could see energy. They're selling a flat tape. That's longs getting out. and they're buying natural gas. That's new longs getting in, right? Up 2 standard deviations, they're covering shorts. Natural gas, they're adding. So natural gas, they're buying it sideways, they're buying it higher, and they're selling it lower. So in 2 of the 3 scenarios here, if you want to look at it just in colors, flat they buy, up they buy, down they sell. You want to be long natural gas. If a dip comes and the market holds a technical level, know that there's more buying coming in. That's how you look at it, right? If you want to look at it in terms of colors, we'll do that with gold, right? Flat tape lower, up tape lower, down tape lower. Okay, so in every rally, if the CTAs were the only players in the market, you'd be like, oh shit, we're done, we're going down. All right. So if the macro discretionary wasn't in this market, this would be big alarm bells for me. And it is alarm bells, just not as big as it usually is. And that's it for the Goldman. We take a break here and we'll come back and we'll do Bank of America. Okay, break over. Bank of America. Let's go squeeze that in there. How about a little bit bigger? Is that too big? No, that's actually pretty good. All right, we can work with that. All right, I'm looking through this in depth for myself today, so I'm going to give you a little bit of a follow along. Their report is words followed by data, and that makes for a good read. Obviously, for me, the Goldman report is better for data. How much better than Bank of America? I can't really tell you, but the written part of the Bank of America post is helpful, right? So you can go through here and you could say, okay, I care about currencies. I care about equities. I care about bonds. And then he goes to commodities. I care about commodities. So let's read that first. In commodities, our model indicates that stretched copper longs likely contributed to larger CTA declines on Wednesday last week, and that further declines could force those who are still long to unwind more aggressively. Now, just listen to that, okay? That's phrasing, and it's not something to be worried about, but it's phrasing. I said the same thing looking at the Goldman report, okay, but not as eloquently. The point is, they're not contradicting what we've seen in the Goldman report here. Okay. Now, why are they focused on copper? Because they're focused on the commodity that has the biggest likelihood to be affected by CTAs. That's what they're going to do, and that's something I think that Bank of America is very good at. Our model projects that oil trend strength will turn negative, opening the possibility for shorts next week. Okay. And what did we see in the Goldman report? That they're short oil, but they're shorter products. So it seems to say that they think CTAs will add to short positions in a drop in oil. So if oil drops, it'll be accelerated by people getting in. And if copper drops, it'll be accelerated by people getting out. SPX Gamma, large in size. All right, this is something that Zero Hedge has been covering for about a year and a half, and that has been studied by Spot Gamma, and has been something that's been part of my portfolio management for decades. It's just very hard to translate for the public. And I'm going to spell it out for you, right? In a very simple way. There are 2 types of people that trade options. There are many types, but we're going to divide them into 2 categories. Those that hedge direction and those that do not. Those that do not hedge direction are directional. I buy calls because I think it's going to go up. Those that do not hedge direction make money from moves. They don't trade volatility. Now, those people get in and get out like CTAs do. They buy calls. If it goes against them, they sell calls. They buy calls. If it goes for them, they might add more and then they'll sell them. What we're concerned about here is the people who hedge direction. Now, those are the gamma hedgers. Now, gamma hedgers, when they're long gamma, buy when the market drops because they get to buy low and sell high. They sell high when the market rallies. They get to make money. The expression is scalping gamma. Now, when those types are short gamma, meaning they're short options to all the speculators, directionally speculators, they tend to buy when it goes up and sell when it goes down. So professionals who hedge directional risk, when they're long options, tend to repress volatility through their natural mechanical activities. Directional hedgers and options tend to exacerbate moves because they hedge direction mechanically as well when they're short options. So when the market drops, if they have to sell because the market is lower, then you're going to see the market have a chance to pick up more momentum lower. All right. Now, so you have these two categories. One is directional, and that would be directional hedge funds, directional speculators, retail, right? And big funds and small funds, all sizes, right? And on the other category, you have what we would call, to simplify it, delta hedgers. Delta hedgers don't really trade direction per se. When it rallies, they sell it. When it drops, they buy it. Or if they are short options, when it rallies, they buy it because they're losing money. And when it drops, they sell it because they're losing money, right? So when they're short options, if they have to trade, they're losing money. If they're long options and they have to trade, they're making money. All right. So that's the two categories. Now we're going to focus on the second category for this analysis. And that second category of people that hedge delta, they're called gamma hedgers. They're called delta hedgers. There are two types of players that do that. One type of player is a dealer. A dealer is someone who, for a living, buys and sells options that other people want to trade directionally. They are market makers. That is my pedigree. It's what I've done, and it's what I'm most well-versed in. All the risk management ability that I have and ability to discuss these things to the extent that I can stems from that education. It's probabilities, it's market structure, it's trading in general, but it's risk management. The other category of trader that hedges risk is a volatility trader, not someone who goes out there and says, I'm going to be a dealer and make markets to make money like a bookie, but someone who says, I think the direction of volatility will change. So they trade the VIX, either directly through the VIX or indirectly through the options on stocks. So that person would say, I think volatility is cheap on IBM. And so he goes out and buys IBM straddles. I think volatility is expensive on NVIDIA. And he goes out and he sells NVIDIA straddles. Now, these are, there are a significant portion of the market and growing that do this. And those are people like myself who leave market making and start trading volatility as a direction. Now, that's been increasing for years, and they tend to move like a herd, but it's hard to see what they're going to do. Look at them as people like myself who start to trade the asset and the volatility instead of the game. So what do I mean by that? You're watching a football game, right? Right? The typical bettor says, I bet on the winner. I bet on the loser, right? The options volatility trader says, I bet on the over-under. That's the way to look at these types. So we're looking exclusively at people that can affect market moves by virtue of their normal, disciplined, mechanical behavior. And those are dealers, market makers, or what we're going to call volatility arbitrage or volatility prop traders. All right, so let's read this. According to our data, so when I say option gamma, you'll see what I mean. According to our data, SPX option gamma ended Friday at 7.6 billion, 97 percentile, an elevated figure, though less extreme than the remarkable level seen in the week prior at 9.5 billion. So what they're saying there is they look at dealers the same way they look at gamma hedgers. They look at gamma hedgers the same way they look at CTAs. They tend to crowd into one side and crowd out of one side. So there are times when they themselves will have to unwind their portfolios and affect volatility itself, on top of the fact that they affect direction. So that's why they're important. Notably, over the past few weeks, as Gamma has grown and remained persistently high, that means they're all long options. Our estimates suggest that the 1 month S&P realized volatility due to Gamma has likewise increased in magnitude and is now minus 1.25 points, 10%. Okay. Our estimates suggest that the reduction in 1 month S&P realized volatility due to Gamma has likely increased. All right. Now, this is actually easy for me to read, but the constant back and forth of negatives and positives might seem wonky. They're actually explaining it quite well. This is what they're saying in English. Because the people who tend to trade volatility are really, really, really long options, they're really long Gamma. And because they're really long Gamma, their tendency to sell high and buy low will squeeze the market even tighter and, in effect, make the market less volatile. So the activity, the normal mechanical behavior activity of Gamma hedgers will actually force volatility in the actual market itself, how much the S&P moves, to decrease. Okay, so they're saying that based on this data, we expect the ranges to be smaller. Now, the next sentence. Going forward, Gamma could be quite dynamic as the bulk of the current Gamma profile is driven by less than 1 week tenors, which will quickly begin to expire. Translation, the thing we just said about the Gamma making the market less volatile will ease a week from now. So to put this in zero hedge terms, that's a Gamma clench. That's the market squeezing into a smaller range because there are too many people trying to do the same thing, right? It's like everyone's too long, so so gold doesn't go up anymore because there's no more money to put into it. Forward, Gamma could be quite dramatic as the bulk. What the hell is that? I don't know why that happened. All right. What the hell? I'm going to pause this for a second and figure out what I just did. All right, bear with me. All right, it went away. So this is, we'll call this a Gamma clench using zero hedge terminology, right? And this would be a Gamma unclench, right? And if you're a metals options trader, we used to call that, well, because everyone was long options, and by that I meant me, the market was going to pin, meaning it was going to start to trade in a very small strike area and gravitate around a strike with large open interest. So clench and unclench, that's a zero hedge story right there. Gamma clench is really bad, but it will last a week. That's the idea for a zero hedge story based on what I just told you. All right, current S&P 1-day systematic flows. This is CTA stuff. You can read that. I want to focus on the options today. Exhibit 2. Wait. Okay, so here we go. According to our Gamma, S&P options Gamma, according to our data, we saw that already. We read that already. All right, so that's basically the same thing we just read, redone. All right, so this is CTA's trading volatility. Okay. This is the graph that you're going to get the most out of. Now they're imitating someone else's graph, but it's quite a nice imitation. I want you to look at the dark area of this graph as the dealer. It's everyone who trades options from a volatility perspective, but just look at it from the market maker point of view. That is Citadel. Okay. Citadel right now, between 5,100 and 5,450 will not let the market move much. They will be aggressive gamma hedgers. They will be selling high and buying low constantly, and they will create a self-fulfilling prophecy by keeping the market in that range and limiting the move. That's your gamma clench. Now, below roughly 5,100, their gamma flips. It goes from positive to negative. So below 5,100, instead of buying low, they're selling low. Now think about this as a market maker. If the market's trading 5,200, I'm a buyer. If the market's trading 5,400, I'm a seller. So I'm buying low, selling high, buying low, selling high. But if there's news, COVID, and the market drops below 5,100, I'm screwed because I went from buying at 5,200 to selling at 5,100. This is positive gamma followed by negative gamma. If you want a description of this, if you're an options person, their position is somewhat like a condor. They're long the 5,200 strike. They're long the 5,400 strike, even more. They're short the 5,500 strike, and they're short the 50 strike, 55,000 strike. Okay, so their position looks like a condor in this area. So you can assume that that's what's going to happen to the market unless news comes out. There's one other thing, speaking as a market maker. Market makers' positions change dramatically and aggressively all the time. So here's what I mean. And they also diverge greatly. So between 5,200 and 5,100, some market makers will fix their position and say, I'm going to be buying puts, and they're going to make sure they don't lose money if the market goes down. Some market makers will not. The divergence am I still recording? I just dropped out here. I just had a mini crash there. Apologies. So, and this is the we're not going to go anywhere else. These are very reliable if the market were to move dramatically right now. But you get this report and the market drops to 5,100, you should expect this market's going to keep going, right? Market goes to 5,500, you should expect this market's going to keep going. The thing is, if the market works its way down to 5,100, market makers like myself, right, that are risk managers, will work on unwinding their position. They'll work on massaging the risk. Some market makers, the bigger ones like Citadel, they won't massage their position. They'll let it stay that way for various reasons. They have access to other markets that we don't. So there you have it. This is very important if you're a technical trader too, because if you have a level 5,100 as an inflection point and we get below it, well, you have another reason to let your profits run. Now, what's this end of the day S&P X 500 option gamma for Delta hedgers? Okay, so basically this is immediate gamma right here. So they're pretty high. They're not at their highest, but they're pretty high. All right, moving on. SPX option gamma position. There you go. So this is the same chart with time laid over on it. So if you're an options trader, you know what a condor looks like. You could see that their position, right, today is the blue histogram. And as time goes on, in 1 month, they're short options. Okay. So you should assume that between now and 1 month from now, they will be buying deferred options, right? They should be buying options 1 month from now. So that's the whole concept. And, there's a lot of risk implications that I'll just throw this out at you. If I see that position on dealers, then I know that the dealers are probably net very short options in the mid to back months. And they're just buying the front month options as a band-aid on a bullet hole. So they're buying gamma to protect Vega risk. That says to me, the dealers are short volatility, betting that volatility will not hurt them too much because of the implied volatility, and they're long gamma to protect their positions. The question is, will they really hedge their gamma as mechanically as everyone thinks? And I happen to know that the answer is no, they will not. Depends on what volatility does. All right. You can figure that out on your own. I'll explain it some other time. Impact of delta hedging on S&P 500 rise vol. Okay, so what they're trying to quantify here, and I don't know that this is good data. I do know that if they do the same discipline every week, it'll become good data for you because you have a reference point and a relativity area. So what they're saying is that the effect from the market volatility the marketplace itself, not the options volatility, will be affected by the delta and gamma hedging. So dealers and market makers buying low and selling high are going to generally decrease the range. So if you're not really sure what I'm talking about here, I'll just put it in a simple concept here. Options volatility is implied volatility. It is the implied or predictive volatility of what the market will actually do. Realized volatility, or what they also call historical volatility, is what the market actually does. So if implied volatility is, let's say, 30%, that says for the 30 days, that says for the next 30 days, options predict that volatility in the market will be 30%. What will the actual volatility in the market realize? And that will it be under 30% or over 30%? They're saying, based on the gamma positions of these guys, that it will be less than implied volatility. And you can play that any way you want to, but that's how it works. Between expiring and on, this is a nice little chart here. So what they're saying here is what I was just describing to you. This is a way to quantify time spread risk, right? What did I just say to you? I said that they're probably short deferred options and long front month options, a band-aid on a bullet hole. This is a graphic representation of that. Let's see if I can parse it for you. It doesn't show anything strong, but it shows that green total. Okay, so you don't care about the total. What I care about is the expiring volume, expiring open interest, non-expiring options. Okay, so it's a total gamma number, so it's really not going to be helpful when you compare it to that histogram. All it's saying is that when you look at the total gamma that these guys have, $3 of it is expiring of the $6 they have. This is going to be useless for someone looking at the market between 5,200 and 5,600. Okay, it's a snapshot. It's like looking at a movie still in a movie and trying to figure out what the movie's about. I wouldn't use that unless you're really professional. Trend following CTA model. We've gone through these before. Let's take a look at gold. Gold long 61% trend strength, bearish 52%, median 55%. Okay, so this is very neutralish, right? If you're looking at this quickly, what you're looking for is dark green or dark red. The darker green it is, the more predictively bullish it is. The darker red it is, the more predictively bearish it is, right? So meaning there's more to come if it's dark green. There's more to come if it's dark red, okay? So for example, soybean oil, there's going to be a lot more selling, okay? The SX7E, what's that, Europe or Asia? There's going to be a lot more buying, right? So copper, here you go. Wait a minute. Maybe I'm wrong. Okay, I'm backwards on that. It's been a while since I've looked at this one. The darker green it is the more closer the darker green it is, the more bullish it is, and the more positioned they are for a bull move. So you could say that at 90%, it's almost like overbought. And at 74%, it's almost like oversold. So copper, neutral, 90%, 81%, 86%, 86%. All right, I'll read this for you. All right. The models right now are neutral. They're not buying or selling. 90% of their positions are long. That's how maxed out they are, right? Bearish, 81%. Okay, I'm having a hard time with this. It's been a while since I've looked at it. I'll have to look at it again. Let's look at, okay, sell trigger. Hold on. Okay. Let's do this right. Take my time here and get this right for you all. All right. 5-day trend projection. Given the color, how strong of a signal is it? Right? So right now right now the flows are neutral. 90%, this is really convoluted, right? If you know how to use it, you know how to use it. The trend strength is 90%, meaning essentially that they're 90% invested on the long side. Bearish, 81% are invested. Median, meaning neutral, 86% are invested. Bullish, 86%. All right, now watch. 90% are invested. If the market drops, the signal will decrease to 81% bullish. It'll back off. If the market sits sideways, 86%, it'll also back off. And if the market goes up, 86%, it'll also back off. All three of these numbers say that over the next 5 days, this signal will weaken. You should assume, unless the market rallies for another reason, that there will be CTA selling. And if only CTAs were in this market, and it kind of feels like it is outside of whoever the big whales are manipulating it back and forth, then you would say sideways is bearish, lower is bearish, and even higher is slightly bearish. Okay, so copper is a good example of that. Now, gold. Buy programs are still in the market. Overall, the trend strength is 61%. 5 days from now, if the market drops, that signal will back off by 9%. If the market goes sideways, that signal will back off by 6%. If the market goes up, that signal will back off by 2% net. Some will buy, some will sell. And that's how it works. Let's look at oil because the oil is the opposite, right? Oil, completely neutral, no positions. There's no signal right now. Anyone who's in this market right now is not trading oil. Now, we're not talking about products, we're about oil. Algorithmically, right? So if the market starts, this is classic algo trading. If the market, they're biased bearish, it's a negative, but it's a 0. If the market drops, they'll get a 30% signal to sell. If the market stays neutral, they'll get a 21% signal to sell. And if the market rallies, they'll still be tiny sellers. That's the way to look at these. And then you have your sell triggers after that. That's it. We've done it all. Hope it was as good for you as it was for me. Cheers.